You've heard about financial scandals involving audit firms, but you've never really understood them. What was the role of an auditor? We're going to clarify that in this video. The term audit is very broad and refers to the practice by which an individual, usually a firm, analyzes data and gives an opinion. An audit can be internal or external, contractual or legal. In the case of a statutory audit, it's also referred to as commissariat aux comptes, a term we'll clarify here. The purpose of a statutory audit is to have a company's or even an association's accounts certified by an external and independent firm. It's essential that the published accounts are validated by a third party to allow for their approval and to give these accounts evidential value. The auditor will therefore work on the accounts during their preparation and verify through various types of checks that the accounts do not contain what are called significant anomalies. Of course, the auditor cannot check every single transaction that has taken place in a company over the course of a year. So, they will start with a risk analysis and focus their checks on the riskiest aspects. When an auditor prepares their work program, they will therefore take into account the risks related to the company's activities. For example, in the case of a jewelry store, special attention will be paid to the protection of inventory. In the case of a construction company, validating the completeness of revenue and the correct application of the various VAT rates will be fundamental. The audit team will carry out these checks by analyzing recorded entries and validating various criteria, known as assertions in professional terminology, such as the completeness of transactions or their correct valuation. Different types of controls will be performed. For example, reconciliation checks can be performed as well as document checks, such as comparing an invoice with its accounting entry, analytical tests like calculating ratios and year-over-year changes, or finally, procedural controls to ensure that the audited company has a reliable system in place to limit the risk of fraud. At the end of these checks, there are two possible scenarios. Either the audit team has not detected any significant anomalies, in which case the auditor can certify the accounts, or on the contrary, significant anomalies have been found. The auditor must then refuse to certify the accounts or, in certain specific cases, issue a qualification to their certification. The report in which the auditor's opinion is expressed is public and is presented at the ordinary general meeting. The statutory audit mission includes other obligations, notably the alert procedure, which involves checking the financial health of the audited company and, in the event of significant financial difficulties, informing the company so it can find the necessary solutions. Of course, auditing does have certain limitations. First of all, it is important to clearly understand its purpose and not to confuse it with other professions, such as chartered accountants or tax inspectors. On the other hand, it is necessary to keep in mind that the auditor has an obligation of means, not of results. They do everything possible to ensure that the accounts are properly certified. We understand the necessity of statutory auditing, certifying the accounts so that third parties can have confidence in them, or on the contrary, refusing to certify them in order to inform third parties of any anomalies detected.